Debt refinancing with lower interest rates. If you're struggling to pay off your credit card debt with high interest rates, refinancing can be an excellent way to reduce the interest and pay less over time. In this video, we will explain how credit card refinancing works, how you can obtain credit with lower interest rates, and what to consider when choosing the best refinancing options. Refinancing a credit card debt is basically taking out a new loan or using a new line of credit with a lower interest rate to pay off existing debts, replacing the terms of your current credit card. How does credit card debt refinancing work? You can refinance your credit card debt through a personal loan, a balance transfer to a credit card with lower promotional rates, or, in some cases, even a secured loan, like a home equity loan, which offers lower rates. Practical example. Suppose you have $8,000 in credit card debt with an interest rate of 24%. If you manage to refinance that debt with a personal loan that has an interest rate of 12%, you could significantly reduce the interest paid over time. Before refinancing. Owe debt, $8,000. Owe interest rate, 24%. Owe monthly payment, $400. Owe total paid after 1 year, $9,600, including interest. After refinancing. Owe debt, $8,000. Owe interest rate, 12%. Owe monthly payment, $400. Owe total paid after 1 year, $8,800, including interest. In the example above, the savings would be $800 in total interest paid over the course of 1 year, without changing the monthly payment. Types of credit card debt refinancing. There are several refinancing options to help you reduce the interest on your credit card debt. Personal refinancing loan. You take out a personal loan with a lower interest rate and use the amount to pay off the balance on your credit cards. Balance transfer to a low interest rate card. Credit cards offer 0% APR promotions for balance transfers for a period of 12 to 18 months. What to consider before making a decision. Now that you know how debt refinancing works, it's important to know how to choose the best option for your financial situation. There are several factors to consider before making this decision. Compare interest rates. Make sure to compare the interest rates of the different refinancing options. The lower the interest rate, the more you save in interest over time. For effective refinancing, the interest rate needs to be considerably lower than your current credit card rate. Practical example. You have $10,000 in debt with a 25% APR on your credit card. You are considering the following options. Personal loan, 12% APR. Balance transfer card, 0% APR for 18 months. Secured loan, home equity 7% APR. The best option would be the 0% APR balance transfer card for 18 months, as you would pay less interest during that period. However, if you're unable to pay off the debt within the promotional period, the personal loan with 12% APR could be a good long-term option. Consider the associated fees and costs. Some refinancing methods come with additional fees, such as balance transfer fees or origination costs for a personal loan. Make sure to take these costs into account when comparing options. Practical example. The credit card offers 0% APR for 18 months but charges a 3% fee for balance transfers. If you transfer $5,000, it would cost $150 in transfer fees. Even with this fee, it could still be a worthwhile option if you can pay off the debt within the promotional period. Payment term and flexibility. Check the payment term for each refinancing option. Credit cards with 0% APR may seem attractive at first, but if you can't pay off the debt during the promotional period, you will be charged back with high interest rates. In contrast, a personal loan may offer a fixed term with predictable rates. Practical example: 0% APR credit card. You have 18 months to pay off the debt without interest. If you don't pay within that time frame, the interest rate could increase to 22%. Personal loan. You have 5 years to pay with a fixed 12% interest rate. If you're confident you can pay off the debt within the 18-month promotional period, the 0% APR credit card might be the best option. Otherwise, the personal loan with a fixed rate and longer terms could be a safer choice. Avoid accumulating new debt during the process. One of the pitfalls of refinancing is falling into the temptation of using your credit cards again, especially if the refinancing is done with a 0% APR credit card. This can lead to more debt and complicate your financial situation even further. Practical steps to refinance your credit card debt. Now, let's take a look at the step-by-step process for refinancing your credit card debt. Step 1. Assess your financial situation. Before refinancing, take an inventory of all your debts and interest rates. Know exactly how much you owe, the interest rates involved, and how much you can afford to pay monthly. Step 2. Research refinancing options. Compare options such as personal loans, balance transfer credit cards, and secured loans. Be sure to consider the interest rate, payment term, additional fees, and any other costs involved. Step 3. Apply for refinancing. Once you've chosen the best option, apply with the financial institution. If it's a personal loan or secured loan, provide the necessary documents and wait for approval. If it's a balance transfer, request the transfer directly from the card issuer. Step 4. Pay off the debt with the new credit. Once approved, use the new loan or credit card to pay off your existing debt. Be sure to cancel the old cards to avoid accumulating new debt. Step 5. Track your progress and stay on top of payments. Now that you've refinanced your debt, follow a disciplined payment plan to pay off the debt as quickly as possible. If possible, pay more than the minimum to reduce the principal balance more rapidly. Refinancing your credit card debt can be an effective solution to reduce interest rates and make debt repayment easier. However, it's important to choose the right refinancing option and commit to paying off the debt responsibly. With discipline and planning, you can pay off your credit card debt more quickly and achieve stronger financial health.